Welcome to the Nichols Tax Update Podcast, issue 21-32. Here is our standard disclaimer. I've stopped reading that week after week, but I do always want to acknowledge the value of my subscription to Tax Notes Today, published by tax analysts, in my opinion, the preeminent source of information for tax professionals and the primary source of my information for this program. Let's see what we have to talk about. 7 subjects. I need to update what? My EIN number? Why and when? Next, a court has ruled that a refund of taxes withheld from a bankrupt spouse's wages cannot be attributed to the other spouse, and so the entire refund is property of the bankrupt estate. Next, some speculation about the trouble that the advanced child tax credit is going to cause in the returns for 2021 of some taxpayers who received the advance credit automatically because their income for 2019 was low, but their income, or 2020 was low, but their income for 2021 is higher. We've been through some of that with Obamacare, right? Next, a CPA is permitted to testify as an expert witness on the complexity of QuickBooks in a lawsuit by the government where the complexity of QuickBooks is an important issue. Next, all of an author's income is subject to self-employment tax. The total income was $5 million for royalties and personal appearances. It's all subject to self-employment tax. You'll get a kick out of how the CPA who prepared the return figured it should have been calculated. And then we have more guidance on the employee retention credit. And finally this week, a practice unit. One of those IRS training programs explains what a reportable transaction is, the Form 8886, and the penalty for failing to file it. Speaking of forms, here's the Form 8822B, change of address or responsible party for a business. Lines 8 and 9 are the subject of the IRS guidance I mentioned in my opening. The following slide is going to tell us how and when, but look at all the information that we are to provide. Here's the deal, right? When the responsible party changes, you must change the information. You didn't change your address, and the business EIN number continues, but someone has bought the business. The person who started the business has sold the business, and another person has bought it. Bought the name, bought the entity, bought the inventory, bought the building, bought the land, bought the machines. You must advise the Internal Revenue Service of a change in responsible party. Change is the only constant, a wise man once said, and that EIN must be updated when the responsible party changes. You have 60 days from the date of any change to update the name of the responsible party. That's on line 7 of your SS4. And when the number is no longer in use, by the way, it will never be assigned to anyone else. But when it is no longer in use, you should close your IRS tax account, following the steps at canceling an EIN, closing your account. No big mystery here. You simply write to the IRS, sending them a copy of that original notice of assignment of your EIN number, or in the alternative, provide all the information and they will close your account, meaning they no longer expect to see returns from you. Here is the Bankruptcy Form 101, Voluntary Petition for Individuals Filing for Bankruptcy. Now, the note on the right-hand side of your screen, not required to be a joint filing, is a note that I entered on this slide. It's not part of the form. I did that to call your attention to this fact that spouses can file for bankruptcy separately. One spouse may in fact be insolvent and needs bankruptcy protection, but the other spouse is not and does not. And so you would file for bankruptcy protection only for debtor number 1, which would be the filing spouse, and there would be no debtor number 2. In this case, we have the question of what about the withholding tax that was paid on the wages of the debtor. The insolvent spouse, the debtor, filed for bankruptcy protection but was not joined by his solvent spouse. The couple had filed a joint Form 1040 claiming a refund. The debtor had earned all of the income that year, made all the tax payments, so no amount of the refund should go to his non-debtor spouse. There are 4 possible ways, according to the judge here, in which the tax refund could be allocated. There's the 50-50 rule. Regardless of who earned the money and paid the tax, just split it down the middle, and some bankruptcy judges have used that. There's the withholding rule. You refund in proportion to the spouse's respective withholding or payments of estimated tax. So the spouse that made the payment gets the refund, and in this case, the refund goes into the bankruptcy estate. That is the more common method, the withholding rule. Then there's the income rule, pro rata, according to the income generated by each spouse, regardless of who had withholding and who made estimated tax payments. And finally, the separate filings rule, based on what the tax liabilities would have been, pro rata, had each spouse filed separately, given their individual facts. Now, the citation, if you want to read more about the 4 possible ways, is the bankruptcy of McInerney, but be careful. There have been a lot of taxpayers named McInerney who filed for bankruptcy. You want to go to 609 Bankruptcy Reporter 497. There is another one at 509. It's also a McInerney, but it has nothing to do with us. The advanced child tax credit payments promise confusion and practitioner ill will. I know I'm not looking forward to trying to reconcile the advanced child tax credits paid to a client in 2021 based on their 2020 income when they were unemployed, but they're employed again, making $180,000 a year, and we've got some reconciliation to do. I have sort of a here we go again response with the government deciding to advance money based on the taxpayer's prior year return without requiring the taxpayer to file for anything. It's just automatic. Here, because you're a citizen, here's some money. The problem, highlighted by practitioners' recent experience with Obamacare subsidies that had to be repaid because the taxpayer's income went up when the taxpayer went back to work or got a better job, was lots of headaches. Social engineering with tax subsidies paid in year 2 based on a taxpayer's income in year 1, a bad year, that must be repaid when the year 2 Form 1040 is filed, were a compliance disaster, according to many practitioners, and I expect they will be a compliance disaster again. The government expects us to be very good at this. Fortunately, we have little computers that can help us with the math, but it seems that our representatives in Congress have no understanding of what we do and how complex it can be. The federal rule regarding expert testimony allows, in the United States versus Dale Vernon Thrush, a CPA to testify as to the complexity of QuickBooks. Could it reasonably take Mr. Thrush almost 2 years to straighten out his books after a bookkeeper who was a thief left them in a mess? He hired a new bookkeeper. The new bookkeeper had to keep books on the business as it was being conducted currently, and also had to reconstruct over 2 years worth of, over several years, over several years, when the former bookkeeper was cooking the books. So QuickBooks, as we know, is a small business accounting system with which this individual was acknowledged to be an expert. According to the federal rules of evidence, a witness who is qualified as an expert by knowledge, skill, experience, training, or education may testify in the form of providing an opinion or otherwise if the expert's scientific, technical, or other specialized knowledge will help the trier of fact, that is, help the judge to understand the evidence or determine a fact and issue. How many federal judges do you suspect understand QuickBooks and how complex QuickBooks can get? You need an expert to tell the judge whether it was reasonable to take 2 years to straighten out the books or not. Now, the testimony of that expert may be believable. There may be rebuttal testimony, but that expert is going to be permitted to testify. That's how the system works. An author is earning money. It's all self-employment income. Look at what I found in clip art. My really great book, Signing with Both Hands. Kay Slaughter, a writer of mystery novels, wrote, physically sat at her desk and only wrote a portion of the time, about 16% of the days. She was actually at her desk writing, and her CPA said only 16% of the $5 million she earned is self-employment income, because that's the only time she was physically working. You can't make this stuff up, right? We've talked about this more than once. The percentage of time actually writing, the court rejected that concept altogether. The percentage of time actually writing should not be applied to over $5 million of total income to determine how much was subject to self-employment tax. It's all subject to self-employment tax. The money she got for personal appearances, directly associated with her book. If she hadn't written the book, they wouldn't give her any money for showing up. Money she got at book signing, selling her books, earnings from book sales. If she hadn't written the book, she couldn't sell the book. It's all part and parcel of a unitary effort which earned over $5 million in the year under examination, and it's all subject to self-employment tax. Next, more guidance on the employee retention credit. There's the employee that we want to retain, singled out right there under the magnifying glass. Wages paid after June 30th, 2021 and before 1/1/2022, the last 2 quarters of 2021. This guidance, notice 2021-49, amplifies prior guidance to apply the same guidance to the 3rd and 4th quarters of 2021, plus it expands the definition of eligible employer to include recovery startup businesses. There's a separate credit limit that applies, but the new definition includes a business that is started up in the 3rd or 4th quarter, modifies the definition of qualified wages for severely financially distressed employers, and addresses whether wages paid to majority owners and their spouses may be treated as qualified wages. It's not a simple read, and there are some good summaries available, but you do need to grab it, especially if you are concerned about majority owners and their spouses being treated as related parties for purposes of the employee retention credit. The IRS's reasoning here has been questioned by some very capable experts, but it is the IRS's position in any event, and we need to understand it. Finally, an IRS training course on reportable transaction penalty. Practice Unit PIN P003 on June the 4th of 2021. Did the taxpayer participate in one of the reportable transactions listed here? A listed transaction, a confidential transaction, one that they couldn't tell anybody about. They had to sign a confidentiality agreement. Transactions with contractual protection. If anything goes south with this, we'll make you whole. Lost transactions, transactions that threw losses of significant amounts. And finally, transactions that have been designated as transactions of interest, which change from time to time. If the answer is yes, then a Form 8886 is required. What is a listed transaction? Well, it's a tax strategy that is described in the published guidance as a listed transaction. Wait a minute, you can't define listed transactions as a list of listed transactions, but we do. There are 36 transactions identified in revenue rulings and notices in chronological order from Revenue Ruling 90-105 to Notice 2017-10. They are listed at www.irs.gov, and you search for listed transactions, plural. The 36 transactions mentioned above are further explained, such as the example below here. This is example number 12 in that list of 36. Notice 2001-17. This is section 351, contingent liability shelter. Transactions involving a loss on the sale of stock acquired in a purported 351 transfer of a high basis asset to a corporation, followed by the corporation's assumption of a liability that the transferor has not taken into account for federal income tax purposes. That's identified as a listed transaction on January 18, 2001. Here's the Form 8886. Now, notice the listed transaction has a subset, and that subset is listed in the IRS.gov website. Confidential transactions are identified by their characteristics. You enter into the transaction, you sign a confidentiality agreement. The same with contractual protection, the same with loss protection. Transactions of interest, however, is not a static list. That list changes from time to time, and these are the types of transactions that would be listed transactions, or will be, if the IRS determines they are in fact being abused. The IRS simply wants information about who is participating in transactions of interest and how big they are, how many they are, and how big they are. But this is the Form 8886. It is required to be filed with a return that reports participation in any of these reportable transactions. Here are the penalties that are imposed by Code Section 6707A. And by the way, if you're curious like I am, what is 6707? Well, 6707 is a similar code section that talks about the penalties that are imposed on anyone who's required to report as a advisor, as a material advisor. So 6707 imposes penalties on material advisors. 6707A imposes penalties on the suckers that buy into these tax shelters. Notice, for a natural person, the maximum penalty is $100,000. The minimum is $5,000. And for all other reportable transactions, not listed, but still reportable, the maximum is $10,000 and the minimum is $5,000. Believe it or not, gang, that's a wrap for this week. I appreciate your participation and your support. Stay safe. We're all going to get through this together. I know it.